Hi there, I'm Susan Hayek with the Group Pension Division of Brokers Alliance. I'm here to talk to you today about 401k plans, actually the basics of 401k plans. And I appreciate the fact that you're here today with me. 401ks, a little bit of a history. In 1978, 401ks were established as actually a subsection of IRC section, and IRC I'm referring to the Internal Revenue Code of 401. It actually allowed for the deferral of income from taxes to save tax deferred for tax purposes. On January 1st of 1980, 401k plans became law, meaning you and me, any kind of an employee in a plan or any plan that existed could actually adopt a 401k provision. By 1983, over 50% of all large firms in the country, Fortune 500, etc., were offering some form of a 401k plan to their participants, whereas in the past they were only offering traditional defined benefit plans. And believe it or not, only a year later, by 1984, over 18,000 companies were offering 401k plans to their participants. Non-discrimination laws actually started coming about in 1984, so from a plan's perspective, they wanted to make sure that those plans were providing a benefit that was equal to non-highly compensated employees and highly compensated employees. So in a sense, they were trying to make it all fair in the new defined contribution 401k world, which again was a little bit different than the old pension world that our parents and our grandparents actually had. Believe it or not, by 1985, there were over 8 million participants in 401k plans, and there were a little over $100 million in assets. A mere 25 years later, in 2010, based on a recent study by ICI, which is the Investment Company Institute, 2010 there were 65 million participants and $3.1 trillion invested in 401k plans. As of 12/31/10, there were a little over $17 trillion invested in all qualified retirement plans, which would include government plans, annuity plans, defined benefit plans, and the like. In a recent EBRI study, and that's the Employee Benefit Research Institute out of Washington, D.C., that does studies based on all kinds of different employee benefits, but specifically they do have categories that relate only to retirement plans. They did a retirement confidence survey in which they asked participants, do you participate in a 401k plan? How much money do you think you might need to retire? And this is where this comes into play with 401ks. Over 39% of all workers said that they believed that they needed over $500,000 to actually fully retire. 19% of all workers believed they needed between $250,000 and $500,000, and 31% of the workers that exist in the workforce today believe that they need less than $250,000 to retire. Now, the Profit Sharing Council of America, which deals with profit sharing plans and 401k plans, they did a 2010 survey, and according to their results, a person to retire needs about 10 times what their salary was when they were ready to retire. With the average salary of an American worker being around $60,000 a year, that means they're going to need at least $600,000 in their plan to retire. So some of the statistics that I just talked about are a little bit misleading from the standpoint of what people think they might need for retirement versus what you probably will need for retirement is very different. Right now, based on the EBRI study, 25% of participants in plans have less than $25,000 in their 401k plan today saved for retirement. 59% of those people are actually saving money, but is it going to be enough? The 401k plan is one of the most perfect vehicles to establish to save money for retirement. It's actually a profit sharing plan from when plans were actually established and made available to employers to set up. However, it's got a deferral feature, which sometimes you'll hear people refer to that as a coda on a profit sharing plan. Typically that's an existing plan that's a little older. And a coda is actually a cash or deferred arrangement, meaning I'm deferring money to pay taxes on it sometimes at a later point in time. And again, the 401k plan has become the most popular form of plan to be established and to be utilized to save money. Who establishes a 401k plan? Well, an individual can establish a 401k plan. A lot of times they refer to them as IKs. I could be a sole proprietor with Schedule C income. I might be a small employer. I might be a partnership. I might be an LLC. I might be an S Corp, or I might be a C Corp. Actually, all of these entities can establish a plan. but it's important to know what kind of entity you're dealing with so that you know what kind of compensation you might be dealing with to determine what their capability is for contributions. Why does somebody want to establish a plan? Well, basically to save money tax deferred, and from a company perspective, they want to do that because they do want to retain employees, and it's used as a recruitment tool. The number two reasons, or the number two questions, I should say, that employees ask of a potential employer is, do you have health care coverage and do you have a qualified retirement plan that I can participate in? So it's very important in that respect. Again, from the standpoint of who are the owners of the company, what kind of companies, these are the kind of questions you want to ask and go over when you're looking at establishing a 401k plan. The other things that you want to actually look for is, again, ownership interests. Do they own any other companies? What is their compensation? What is their capability to actually fund that particular plan? And from an employee's perspective, what's the demographics of the employees? All that is key information in establishing any plan, but in a 401k plan, it's very important as well. Now, there are testing requirements in a 401k plan that are a little bit different than maybe some of the other plans. And those are basically called the ADP-ACP testing, which is non-discrimination. They're average deferral percentages based upon who's contributing to the plan and who isn't contributing to the plan. Those do come into play. However, you can take the 401k plan and decide to add on safe harbor provisions. Safe harbor provisions for a 401k plan will allow you to actually mitigate some of those non-discrimination testing in favor of offering a contribution to the plan of either some type of a match or an employer discretionary contribution. Once you do that and it becomes safe harbor, you don't need to worry about the average deferral percentage. And what happens then is that allows employees then to put up to potentially the maximum in the plan, which for 2011 is $16,500. Okay, usually the deferral is a percentage. It's some percentage of pay. If I'm an employee and let's say I make $25,000 a year and I say I want to save 10% of my money for that particular year, then I'm going to defer about $2,500. It can, however, be a dollar amount. It all depends on how your employer is handling that. Instead of a percentage, what I could do is I could always say, listen, I'd like to defer $25 a pay period. So you can do percentages or dollar amounts. And usually from an eligibility perspective, you've got an age of 21 and the most they can ask for is 1 full year of service before I'm able to defer. It can be less than that, and some plans are set up where I can start deferring immediately upon employment. Now, in a 401k plan, employee contributions are always 100% vested. That's always money that that employee can take with them if they were to terminate employment or at any point in time utilize that if there are loan provisions or withdrawal provisions in the plan. And that's important to know because a lot of employees think, hey, it's my money, I want to be able to get at it if I need to. Now, employer contributions are subject to a vesting schedule. An employer can have no vesting schedule or they can have a vesting schedule that might be what we call a 6-year graded, meaning every year that you work there, you get another 20% of that money vested. And then once you've been employed 6 years, you're 100% vested in the employer contribution. Now, we did talk a little bit about safe harbor plans a little bit earlier, and one of the things that happens if you decide to operate the plan as a safe harbor plan is that all of the safe harbor contributions, whether that's match money or whether that's employer non-discretionary money, that becomes 100% vested as well. Now, what's great about the safe harbor plan, as I stated a little bit earlier, is you do not have to do ADP or ACP testing. And you do need to notify, though, the employees on any given year, at least 30 days prior to the year end, whether or not you plan on operating the plan or maybe plan on operating the plan as a safe harbor plan. Employer, as I stated earlier, employer and employee contributions that are used from safe harbor are always 100% vested, as well as any employee deferral money. And what came about with the Pension Protection Act of 2006 is that Roth provisions were actually introduced, meaning I could add a Roth provision to my 401k plan and allow an employee to actually defer money. It's not tax deferred, it's actually deferring tax, after-tax money into the plan as Roth money, or categorized as Roth money. I'm still being held to the $16,500 limit, so what some people have done is they've combined the pre-tax along with the after-tax to get advantage of a Roth provision within a plan that's being paid for potentially by their employer. Now, on the plan's perspective, what will happen is those plans can either be what's called bundled or unbundled, and that means either you're utilizing the services of an outside third-party administrative firm to set that plan up and to actually do the compliance testing, or you've got a vendor who's actually doing all that for you. There are a plethora of investment options that are available in the 401k environment, and usually the participant has the capability to direct those investments. Target dates, mutual funds, ETFs, individually managed account, even lifetime guaranteed funds are now included in that. What happens though as a participant in a 401k plan is you're always going to get participant disclosures. You're going to get information that tells you everything about the plan. You're going to get a summary plan description. You're going to get the annual notices that tell you whether or not the plan is going to be operated as a safe harbor or not. You're going to be getting quarterly investment statements and benefit statements as required by law. Sometimes the plan will be set up with a qualified default investment alternative, which would be if I have not filled out an enrollment form for the particular plan, then I would automatically get that information for you. The fee disclosure. What's coming? That's going to be a new law in which all the fees for that particular plan would actually be disclosed to you on your participant statement. So what will actually happen then for that is, as a participant, you know exactly what's going on in the plan, you're getting your statements, and most 401k plans are set up where you've got access to that plan 24/7 via either a web or VRU. Well, that pretty much wraps up 401k plans for us today, and I want to thank you so much for joining me.